Hello everybody, it's Chuck Carnevale, co-founder of FastGraph's Fundamentals Analyzer software tool. Had you had the foresight or good fortune or good luck to invest $10,000 in Tencent Holdings, which is an investment holding company headquartered in China, it's internet and value-added services, that $10,000 today would be worth over $378,846, representing a 46.4% compounded annual rate of return over the past decade. If that number is as surprising to you as it was to me, the question would be, how did that happen? How did that get there? Well, the answer is clear. This is a pure growth stock. This company has grown earnings from 8 cents a share in 2009 to $1.08 a share last year and expected to add another 20% growth to $1.30 this year. That's a 38.7% compound growth rate. When I put monthly closing stock prices on here, and by the way, this orange line represents a PE of 38.7, you can see that this stock has traded at a high valuation that's relative to that growth rate. Recently, at the beginning of this year, the stock got pretty fully valued with a PE of almost 54. That's adjusted back down now to a PE of about 41.2, and this is a blended PE, which includes past. It's not trailing 12 months, it's not pure forward, it's past, present, and the next, closest forecast. So, it's moderately overpriced on that basis, but considering the fact that it's expected to grow by over 40% in 2019, it could be a bargain today. And so when you're looking at this company, I don't really have a lot of forecast data, so I'm using historical growth. And this is 36.9% growth here. And you can see that this company would still be able to generate high rates of return if it were to continue to grow, as these analysts are suggesting it might grow going forward. Now, even though this is a pure growth stock, it does pay a dividend. In fact, the dividend growth has been actually exceptional. It went from a penny a share in 2009 and 10, then it doubled to 2 cents a share in 2011, then increased to 3 cents a share for 2012 and 13, 5 cents a share in 2014, and it was 11 cents a share last year. Now, the zeros here simply imply that there's no analyst giving a forecast for what the dividend might be next year. But if you look at the historical dividend growth, you can see that the dividend growth has been extraordinary, averaging over 38% a year. But the current yield's less than 1%. This is really not a dividend stock or a dividend paying stock. As I said, it's a pure growth stock, and it should be looked at and purchased, at least in my opinion, based on its growth potential. Nevertheless, even though it's a growth stock, it does pay a little dividend. Looking at free cash flow, the company's paying out a minuscule portion of its total free cash flow. This company is generating unbelievable growth in almost every metric you can look at. If you look at it from a standpoint of EBITDA, which is a soft form of cash flow in my opinion, you can also see that the company is actually attractively valued, trading at its normal long-term 27 times EBITDA. That's what the orange line in this graph. Again, there are no forecasts for dividends here. That's the only reason why it's left blank. It's not because the company is not going to pay one. Clearly, they have ample cash to do that. Now, this is a stock that, is a pure growth stock. It's headquartered in China. It's A+ rated by Standard & Poor's. It's $465 billion market cap, which is obviously huge for a company that's growing this fast. So one of the things that I always like to suggest that people do is to go ahead and go into the company's website. Now I'm going to translate it into English because it is a Chinese-based company. Now once I've translated it to English, I've gone into investor relations here. And what I've looked for here are some corporate presentations, and I think this is where you can really learn about a company. I don't know this company very well. It's a great growth stock, however, as you can see by the record. So here you can go in and learn more about what the company does, what their platforms are, who their strategic partnerships are with, etc., and research the stock a lot deeper. Additionally, you can go into the company's annual reports, their interim reports, etc. But the real point here is that this is a pure growth stock, and the real key is how do you value this, a growth stock like this? And to me, you value it based on its operating metric. And even though this has higher multiples than you'll see on a lot of companies, trades at normally around 27 times EBITDA. If you look at operating earnings, it trades around 40 times operating earnings, which is the PE of this orange line. You pay high because of the compounding effect. I want you to understand what that means. Look at, they earned 8 cents in 2009. They more than doubled it 2 years later, and then they almost doubled it again. They more than doubled it again 2.5 or 3 years later. It's this compounding of earnings growth here that is creating the value. You can see how the stock price has tracked that perfectly, is that it might be moderately overvalued today, but based on what its expectations are for growth, if it does go back down, if the PE ratio shrinks from 41 to 38.7, and the company does generate this earnings growth as expected by these analysts, you've got a 28% compounded rate of return annualized over the next year and a half or so. This is an interesting growth stock. It's not for the faint of heart. The valuations are high. But it's one you might want to take a closer look at. This has been Chuck Carnevale saying thanks for watching. If you're a subscriber to our YouTube channel, we appreciate it. If not, go ahead and click the subscribe button and become a subscriber. And you might also want to share this with some of your friends. If you're interested in the Fast Graphs research tool, one thing I want to point out about this particular company, I didn't know very much about it. What I did here was just simply analyze it on the fly for you. That's why I call these Analyze Out Loud videos. And you can do the same thing if you have access to the Fast Graphs research tool. Once again, thanks for watching.